You have all heard it. Real estate right now is radioactive. As an attorney who has worked for the banks as well as a closing attorney for individual purchases and sales, I have done hundreds of closings. There was a time in 2020 and 2021 where I did sometimes 8 to 9 closings a day. I mean, the last 2 years has been cutthroat. You don't need me to tell you. I'm sure you all have individual stories, personal stories, or the stories of friends and family that have told you about their experience. Nevertheless, I thought I would come on here and share some not so popular advice if you're looking to invest in real estate, purchase a new home, or even buy a multi-family dwelling. I'm going to lay out some pitfalls that perhaps you've not heard before. Before we get into this topic, this is the legal code, and on this channel we discuss a wide range of legal topics, whether that's estate planning for you and your family, when is the good time to start, as well as small business concerns, whether that's starting your LLC, trademark protection, should you trademark, do you need to copyright, all of those bits and bolts, as well as sometimes some celebrity shenanigans. But again, that's not the bedrock of this channel. We discuss some substantive things so that you can be knowledgeable and can be reinforced as you go out into the world. So if you like that sort of things, please don't forget to give this video a thumbs up, as well as share with anyone else you think will find value. Also, I have some legal consultation slots available, so if you would like the opportunity to work with me one-on-one to troubleshoot any areas of your business, to discuss estate planning, what it involves, who's the right candidate for it, when you should begin preparing for estate planning, we could discuss that in your consultation. Now, without further ado, let's get into this video. Now, to be a landlord of a multi-family dwelling is no small feat, no matter how easy one may make it sound. It is a large undertaking, so you should be extremely prepared and going with math, not just ambition and propaganda. I know there's a lot of noise out there encouraging people to be a multi-family dwelling owner, their first time home purchase. You should have the tenants be paying your mortgage. I see the propaganda with glaring neon sign lights. Now, I'm an ambitious person, but buying a multi-family dwelling on your first home purchase is extremely risky, wrought with things that can go wrong. And I'm going to present it in this video, some things maybe you have not thought about. You could do it, but I want you to have all the facts. Now, if you're going to buy a multi-family dwelling and expect tenants to pay your mortgage, that is a disaster waiting to happen. That's a risk, especially now. First, there's so much job uncertainty that your tenants may face. Just because they have a job now, when they move in, does not mean they will maintain that job for the entire time of their tenancy. With that being said, you should be prepared to absorb the cost of paying the mortgage and maintaining the property without your tenants. This isn't earth science. This is facts. It is disastrous to solely rely on tenant income in order to maintain your home. Don't listen to the propaganda, because only you will be in housing tenant court if your tenant goes rogue or is unable to pay. As frustrating as it may be, take this simple advice. Be able to pay your mortgage without your tenants in the event your tenants don't pay. Because at least if the tenants stop paying, you can continue paying the mortgage, albeit with frustration, but you won't be exposed to foreclosure. And all you would have to do is deal with the eviction and the possible property damage that the tenant may cause. But you won't be dealing with eviction, foreclosure, credit complications, and all of that is involved in that. Next thing about investing in real estate is that there's assumption that the profits will increase exponentially over time. Like there's no cap rate. Well, there is, especially in real estate. So I'm going to discuss cap rates. Cap rates are calculated by dividing your net operating income or rent minus expenses. by the market value of the property. Your expenses may include everything except mortgage payments. You look at the cap rate to determine whether your real estate investment is profitable or a potential disaster. So you have to consider cap rate whenever you're investing in real estate and expect to rent it out. Cap rate also helps us determine what percentage of your property's value is profitable. This is vital information for real estate investors, as it helps to determine if you're actually achieving your ROI, your return on investment, or whether or not the operating costs are making your investment unprofitable. There's a simple formula for figuring out the traditional cap rate, and I'll leave the formula in the description box. But we'll go through a sample. First, you must establish the current market value of the property. You could just go to one of those real estate sites and get the Zestimate on any of the real estate sites. There's not one in particular that you have to use. And then contact your broker or appraiser to get an idea of the current market rates and the value of your property. For this exercise, let's say it's a duplex in Texas valued at $300,000, right? So the next step will be determine the net annual operating income. This includes all income such as rent, parking amenities, like the actual girth of value of income that you can generate from the rental. Net income provides the clearest picture of the day-to-day performance of the rental property. It describes the health of the property because you might be renting out a parking spot as well as the unit. So it includes all of that. Now, using the market value research, check similar units in the area to determine how much those are going for, how much income you can get in annual rent, or use the current numbers if it's a property you have already owned. So let's say, for example, of $300,000 Texas, and let's say you make $1,200 income monthly rent from each of the units. So that's $2,400 a month in total, and $28,800 annually. Next, you want to subtract operating expenses, deduct all costs, excluding mortgage, such as property management, owner association dues, taxes, insurance. If you have PMI, all of that you want to deduct. This leaves us, so all of our operating expenses are at $1,000 a month. This leaves us with a net income of $16,800. Now you want to divide your net income by your asset value. So that's $300,000 by $16,800 in our case. That gives us a cap rate of 5.6%. Not too bad, right? It might be a little risky, and we'll see why just in a minute. Now, one thing about cap rates are correlated to risk. Overall, the higher the cap rate, the riskier the investment. That is, a higher cap rate means that your asset price is low, which typically points to a riskier investment, that you won't be able to generate as much profit. But you must compare market cap rates in your area, as that can vary significantly. So proceed with caution. A property with a high cap rate might not be the best investment for you if you're not in a position to tolerate excessive risk. Say it's in a blighted community. That's an area where there might be higher risk because there's fewer people to rent it out. They don't want to live in that neighborhood, and the income from rent will be generally low. For instance, a property nestled in a hot and in-demand area will have a very different cap rate than a sleepy town somewhere in a rural area. Now, one thing about cap rates are correlated to risk. Overall, the higher the cap rate, the riskier the investment. That is, a high cap rate means your asset price is low, which typically points to a riskier investment. But you must compare market cap rates in your area, as they can vary significantly. So proceed with caution. For instance, a property with a high cap rate might not be the best investment for you if you're not in a position to tolerate excessive risk. Location is everything in real estate, and I know you've heard it. Location, location, location. Location does have a profound effect on a property's cap rate. For instance, a property in a hot and and in-demand downtown location will have a very different cap rate than a sleepy town somewhere in a rural Midwest community. But that doesn't mean that the typical property, let's say in Manhattan, will necessarily have a higher cap rate than in Des Moines, Iowa. Markets with higher demand will have higher priced property and the higher potential for operating costs. But once a market shows signs of cooling and rents take a dip, so will your cap rate, which is sort of like what may be going on right now. There's anticipation of a lowering of rents, but we'll see. On the other hand, chronically low cap rates show less signs of improvements over the long term. Typically, the most robust and reliable cap rates favor urban areas, as well as more highly educated populations, such as college towns, as well as diversified economic bases. So a property with a lower than average cap rate probably isn't a wise investment either. Don't cross your fingers and hope for a greater demand. As a real estate investor, you must have the local knowledge of the underlying fundamentals of the area. A low cap rate may be worthwhile if you know there's perhaps a factory being built, like Amazon is about to be built there in the next 6 months, and jobs will be up and running in maybe 8 months. Or major transportation is about to be developed in that area. So you want to be aware of what's going on short term as well as long term. Some aggressive investors won't even touch a property without a cap rate of less than 8%. Some yet will even insist on double digits. Again, there's a lot of varying factors at play. So a cap rate around 6% might be considered fantastic in certain markets. Again, it depends. So what's a good cap rate? You may be asking. A cap rate between 4% and 5% is optimal according to experts, and most middle class people can afford that. The range yields plenty of potential purposes, and it's stable enough to maintain a steady stream of revenue without assuming undue risk. Again, this totally depends on the fundamentals, as I've laid out in this video, of the real estate markets you operate in. Is there public transportation? Is there a university? Is a university developing a campus there? All of this must be play. Also, every investor's portfolio and circumstances are different. So a good cap rate shouldn't be your only green light. There are many other factors to consider before you make an investment decision. For instance, cash flow. It might be good now. It may not be the same 2 years from now. So how you take a snapshot of what's going on now may be dramatically different in 2 years. A profitable asset for one investor might not always be as profitable for another. It may just be a liability. So you need a whole 360-degree view of it. But regardless of your specific financial positions, a property's cap rate will remain the same from investor to investor, helping you consistently and accurately benchmark profit potential. That's why cap rate is a vital metric to master if you're serious about building wealth and increasing your real estate portfolio. That percentage is universal from investor to investor, but it's whether or not you can absorb those risks. Something else to consider with the cap rate is that there is a limit of how much rent a market is willing to pay. This is really, really important. So although there's a story that you hear that real estate value always goes up and there's always a demand for a dwelling, yes, that's true. But renters are also aware of this dynamic and don't want to continue paying a landlord high rent for forever. Eventually, renters get hip to the game and they want to make home purchases too. And although the market can tolerate higher and higher rents for a dwelling, this might be dwindling as more and more high-income earners begin to own property and opt to own rather than pay these exorbitant rents. So you may attract a six-figure renter who's able to rent for $3,000 for a few years, but eventually they buy their own home, which takes me back to my introduction. To rely on renters for your investment is disastrous. and puts you at a very, very vulnerable position. You as the owner of the home should bear all the risks as much as you enjoy all the profits of someone paying your mortgage. Just like any other investment, you go with the ups and you go with the downs. You don't get to pass on the downs to anyone else. Real estate is the only industry where people are brainwashed into thinking that other people should be able to absorb the risk. But because renters are transient, you should expect the expected, that these people will leave or perhaps not pay their rent, and you will be left to absorb the reality. Therefore, if you're buying for the purpose of renting out, make sure that you can foot the bill, because it's you and no one else that will be responsible for paying that mortgage. If you disagree with me, take a walk down to the nearest foreclosure court. None of those people there are renters. It's the person whose name is on the mortgage that is responsible. So I leave you with that. Let me know your questions. If you have any questions that you want to go over, I'm going to leave the formula in the description box. Let me know your thoughts. If you have any experience being a landlord, what do you think? I want your input as well, especially considering what you think about having tenants pay the mortgage, that propaganda. Do you think it's true? Do you think it's the gospel? Do you think it's a pile of crap? Do you think it's 50-50? Let me know your thoughts, and don't forget to like and subscribe, and I will see you next time. Bye-bye.